Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Taiwan semiconductor manufacturing.
If you find our talks useful, please consider subscribe, like, and comment underneath, and check out the VIP Algos link below in the description.
Yeah, so jumping right in, if you want to build the absolute most advanced artificial intelligence in the world today, you actually don't start in Silicon Valley.
Right, you start on a small island off the coast of China, inside a manufacturing facility that costs, upwards of $20 billion to build?
Exactly. I mean, inside that facility, you have engineers manipulating extreme ultraviolet light in a near-perfect vacuum.
Just to etch these patterns into silicon that are literally smaller than a human virus.
Yeah, it's mind-blowing. And the crazy part is, if that one single factory goes offline, the entire global tech economy essentially just grinds to a halt.
The consolidation of that physical manufacturing power is staggering because, the narrative around AI for the last few years has been entirely floating in the cloud, right?
Oh, absolutely. It's all algorithms, chatbots, autonomous agents.
Right, but the reality is that literally none of that software exists without highly specialized physical atoms. So today is July 16th, 2026, and we are unpacking the underlying engine of this whole AI boom.
Which is Taiwan Semiconductor Manufacturing, universally known as TSM. We really need to look at the raw data, the institutional sentiment, and some pretty serious looming competitive threats.
Because for you listening, the goal is to figure out if this company is the ultimate long-term compounding machine for the AI era, or if the geopolitical risks make it a house of cards.
And the timing right now is crucial. We're seeing this massive shift from conceptual AI hype to just unprecedented physical infrastructure demand.
Yeah, let's talk about that demand. The June sales figures alone saw a 67.9% surge.
A massive acceleration. It just proves that the demand from cloud providers isn't just, projections on a whiteboard anymore. It is actual physical orders materializing.
And with the Q2 earnings expected literally today, the projections are modeling revenues near $39.6 billion. That's a projected 59% jump in second quarter profit year over year.
It's incredible. And looking at the revenue growth, which sits at over 30% on a trailing 12-month basis, you see a company that's just scaling rapidly.
But I want to pause on their margins, because this is where the story gets really weird for a traditional manufacturer.
Yeah, the efficiency is wild.
They are operating with a net margin of 47% and gross margins of almost 62%. Normally, when you see a 47% net margin, you're looking at a software as a service company, right?
Exactly. A business that writes a piece of code once and sells infinite copies for free.
Right. But TSM is dealing in heavy machinery, concrete, billions of dollars in capital expenditures. Achieving software-like margins while building physical objects, how is that even possible?
It comes down to a structural advantage. It's their status as a pure-play foundry.
A foundry being just a factory that manufactures chips.
Right, but the pure play part is the key. It means TSM does not design its own proprietary chips to sell to consumers. They only manufacture designs provided by their clients.
Oh, so they eliminate the conflict of interest entirely.
Exactly. Think about it. If you're Apple or AMD or NVIDIA, you're what's known as a fabless designer. You don't have your own factories.
So you have to offshore your manufacturing. But if you hand your secret blueprints to Samsung or Intel,
you're handing your intellectual property to a company that also builds rival smartphones and processors.
Wow, yeah, that's a massive risk. So by operating as a pure-play foundry, TSM basically guarantees they will never compete with their own customers.
And that neutrality creates an incredibly deep level of trust. When Apple commits to TSM, they optimize their entire chip architecture for TSM's specific manufacturing nodes.
Which creates immense switching costs, I imagine.
Huge. A client can't just take their blueprints to another factory down the street without fundamentally re-engineering the entire chip.
And that costs a fortune. So TSM has this captive, highly profitable customer base generating immense cash flow, which allows them to maintain a fortress balance sheet.
Right, which they need because they are using that cash to fund astronomical capital expenditures. They're building next-generation fabs in Arizona, Japan, and Germany right now.
All without heavily diluting shareholders, right?
Yeah.
I mean, they still manage to maintain dividend payouts and share repurchases.
Because the cash generation is just that strong. The barriers to entry in this industry are entirely capital and knowledge-based.
Okay, but that brings up a glaring question when I look at the valuation data. I'm seeing a trailing price-to-book ratio of 10.65.
Yeah, that's a big number.
Book value is basically the liquidation value of the physical assets.
Yeah.
So a multiple of 10.65 implies investors are paying over 10 times the value of the actual concrete and machines.
Which for a traditional manufacturer would absolutely be a massive red flag.
Exactly. A traditional value investor would look at that premium and run away screaming.
But in this context, that premium reflects the exceptionally high return on equity generated by their model. Investors aren't just pricing in the physical machinery, they are valuing a years-long head start in something called yield optimization.
Let's break that down for the listener. Yield optimization.
Think of a standard high-speed printing press running at maximum capacity. If a single microscopic speck of dust misaligns the ink, millions of copies are ruined.
Right.
With silicon chips, the scale is atomic. You are drawing billions of transistors onto a single silicon wafer. The yield is simply the percentage of chips on that wafer that actually function perfectly when the whole process is done.
So the financial difference between, say, a 40% yield and a 90% yield is the difference between a factory bleeding money and a factory printing cash.
Exactly. And getting that yield up to commercial viability isn't just following an instruction manual. It requires years of continuous tweaking, a highly specialized workforce, just deep institutional muscle memory.
So TSM's knowledge basically allows them to optimize yields on advanced nodes way faster than any competitor who might buy the exact same equipment.
Yes. That 10x premium on the book value is essentially the price of that invisible institutional knowledge.
Okay, so knowing the fundamentals support this, let's look at the current market action. The stock price sits at $419.48, and the momentum is highly constructive.
Very constructive.
We're looking at a 13-week return of 21%, a 26-week return of almost 62%, and it's up 56% year to date.
And the volatility remains relatively constrained. The beta is 1.08, so it moves only slightly more than the broader market.
Which for a high-growth tech stock driving the AI boom, that stability suggests deep institutional conviction, not just retail speculation.
And the institutional flow data completely backs that up. Hedge funds have been buying U.S. semiconductor stocks at the fastest pace in at least 3.5 years.
Yeah, billionaire Lewis Sanders just took a $9.5 billion position in TSM.
Which is massive.
Right. When a whale moves nearly $10 billion into a single equity, they are not executing a short-term day trade. That is a structural thesis that the AI build-out is a multi-year secular trend.
Institutional portfolios are basically positioning TSM as the inescapable beneficiary of this cycle. The smart money views recent sector pullbacks as entry opportunities.
But whenever we see that kind of overwhelming institutional buying, we do have to look at the other side of the trade, which is insider activity.
Always a good idea to check that.
The data shows insider net selling over the last 90 days, totaling over 1.3 million shares. Now, at face value, executives offloading 1 million shares looks bad.
It can look like a vote of no confidence, sure, but we have to evaluate the magnitude against the buying activity. The insider sell-to-buy ratio is roughly 0.46.
Meaning for every 2 shares bought, roughly 1 share is being sold.
Correct. So while there are a higher number of individual sell transactions, the sheer volume of the selling is minimal compared to the institutional buying.
So it's basically just routine executives exercising stock options, rebalancing their personal portfolios.
Exactly. Standard corporate compensation cycles, not an internal exodus of confidence.
Okay, but I noticed a massive contradiction in the pricing data that we really need to untangle here.
The 52-week high thing.
Yes, so it states the current stock price is $419.48, up 56% for the year. But then it explicitly says this price is 83.5% below a 52-week high of $2,535, which it supposedly hit just weeks ago in June 2026.
Yeah, that looks like a bloodbath on paper.
Right. I assume this is an ADR recalibration making this chart look completely crazy.
That's exactly what it is. It's a statistical anomaly tied to the ADR structure. Because TSM is a Taiwanese company, U.S. investors purchase American depository receipts, which represent the form shares.
And occasionally the depository bank just adjusts the ratio of those receipts.
Right. So they might change it so that one ADR represents 10 common shares instead of 1. They adjust the nominal price proportionately overnight, kind of like a stock split.
So the actual underlying value of your investment hasn't changed at all.
Not one bit. But the historical data feeds often lag in retroactively adjusting the past peaks to match that new ratio.
So the chart technically shows a massive drop from a high of 2,535, but it's purely an optical illusion.
100%. The true underlying momentum remains highly constructive and unbroken.
Okay, that clears that up. So with the institutional backing clear, what is the market waiting for next? The immediate catalyst is today, the Q2 earnings call.
Right, and keep in mind the 39.6 billion revenue figure and the massive profit jump are already largely priced in. The market expects perfection today.
So the real volatility tomorrow is going to stem from management's forward-looking commentary.
Exactly. Analysts are going to be hyper-focused on 2026 capacity utilization rates. They need to know if the fabrication plants are booked solid for the next 24 months or if clients are suddenly pulling back.
And the secondary focus has to be the production timeline for the Arizona facility, Fab 21.
That Arizona fab is a massive variable.
Because transplanting TSM's highly specialized manufacturing culture and all that yield optimization muscle memory from Taiwan into the middle of the American desert, that is incredibly complex.
It's notoriously difficult. Any operational delays there will trigger immediate margin concerns on Wall Street.
And beyond the earnings call, there are macroeconomic tailwinds to consider. There's chatter about a dovish policy pivot from the Fed regarding interest rates.
Which is huge for TSM. Interest rates act like financial gravity on stock valuations.
Right, when the discount rate is high, the future cash flows of a growth company are worth a lot less today. If the Fed cuts rates, that gravity weakens.
Especially for a company with massive capital expenditure requirements like TSM. Lower borrowing costs fundamentally expand their valuation multiples.
But the data also highlights some speculative rumors that are definitely not priced in yet. The first one involves their pricing power on upcoming advanced nodes, the 3-nanometer and new 2-nanometer chips.
Yeah, this is fascinating. If the demand for AI computation is truly inelastic right now, TSM might have the leverage to charge significantly more for those 2-nanometer wafers than anyone is currently projecting.
Meaning that 62% gross margin we discussed earlier might just be a floor.
Exactly. We could see unprecedented margin expansion in late 2026.
And the second rumor addresses the physical bottlenecks of AI hardware. There's chatter about strategic co-investments between TSM and major cloud providers for bespoke advanced packaging facilities.
Advanced packaging is quickly becoming the ultimate constraint in AI. We are hitting a physical wall where you literally cannot cram more transistors onto a flat, two-dimensional chip without them melting or interfering with each other.
So the only direction to build is up.
Exactly. Technologies like TSM's CoWoS involve stacking memory and logic chips together like a microscopic high-rise building before attaching them to the motherboard.
And the data bandwidth required for AI workloads absolutely demands this 3D architecture. So if TSM is co-investing with hyperscalers to lock up that packaging process,
they are securing control over the very next major bottleneck in the entire global supply chain. Official confirmation of those partnerships would be a massive upward catalyst.
Okay, but every thesis requires a rigorous examination of the bear case. We've built up this invincible AI juggernaut, but we have to look at the vulnerabilities.
And the omnipresent overhang here is geopolitical, the risk of escalation in the Taiwan Strait.
Right. Having your most advanced manufacturing concentrated on an island subject to intense geopolitical tension is a massive structural risk.
Any physical disruption or blockade there would be catastrophic, not just for TSM, but the entire global technology ecosystem.
But the consensus among institutional investors seems to be that a severe discount is already applied to TSM's multiple to account for that reality, right?
It is, and TSM is actively trying to mitigate the vulnerability by building those fabs in Arizona, Japan, and Germany. They are deliberately de-risking by dispersing capabilities.
Right, geographical diversification. Okay, the second pillar of the bear case is technological competition, specifically from Intel.
Yes. Intel recently hit a major milestone. They took delivery of and are utilizing ASML's most advanced high-NA EUV lithography machines.
EUV being extreme ultraviolet lithography, the machines projecting the light to draw the microscopic patterns.
Right, and high-NA, or high numerical aperture, represents the absolute bleeding edge. It uses larger mirrors to focus the light even tighter, allowing for denser chips.
So if Intel has the absolute best, most advanced tools from ASML, doesn't TSM's technological moat start to look really shallow? I mean, if a competitor can just go buy the best equipment, the advantage shrinks.
You'd think so, but having the physical tool is literally just the entry fee. High-NA EUV is insanely complex, manipulating plasma and optics in a vacuum and integrating that into a continuous, high-volume manufacturing flow without destroying your yield that requires decades of institutional knowledge.
So Intel has the machinery to print the chips, but they still have to figure out the yield optimization to do it profitably at a massive scale.
Exactly. So Intel's milestone shows the technological gap is narrowing, but their foundry operations remain years behind TSM in proven yield and ecosystem integration.
So the real long-term threat isn't that Intel suddenly engineers a better process overnight.
No, the vulnerability lies in state-subsidized competition.
Ah. If the U.S. government heavily subsidizes Intel's foundry build-out for national security reasons,
Intel might have the financial padding to operate at lower margins. They could systematically underbid TSM just to claw back market share.
which would eventually compress TSM's elite pricing power across the entire industry, that is a very realistic long-term structural threat to watch over the next 5 years.
It is. However, evaluating all the immediate data, the fundamentals, the momentum, and the near-term catalysts, the analysis gives TSM a 9 out of 10 bullish score.
A 9 out of 10 indicates exceptionally high conviction. The primary takeaway is that TSM operates as the most critical and most profitable node in the global AI supply chain.
They possess elite margins, a durable moat in the near term, and immense capital inflows. The strategy outlined here views this as a tactical swing trade into today's earnings that transitions into a multi-year prospect.
So for you listening, whether you manage a portfolio or just follow tech trends, understanding TSM is essential. They define the physical speed limit of the AI revolution.
Every breakthrough software model, every data center relies entirely on the microscopic infrastructure that TSM manufactures. They are the quiet engine driving this entire decade.
I want to leave you with a final thought to ponder. The entire bullish consensus for TSM relies on this assumption of insatiable exponential demand for AI workloads. We are in the heavy infrastructure build-out phase right now.
Laying the foundation.
Right. But what happens when that initial global capacity is actually met? Will the demand for physical chips eventually plateau? Or is computing power fundamentally the new oil, a resource we will simply never have enough of, because every drop of computation we generate gets instantly consumed by more complex software?
That is the ultimate question.
And until we discover the answer, the entire industry remains reliant on one indispensable manufacturer. That's all for today. If you found this breakdown valuable, please subscribe, like, and comment underneath, and remember to check out the VIP Algos link below in the description.